consumer credit. And thank you very much for being here. I am Julapa Jaktiani from the Federal Reserve Bank of Philadelphia, and I am one of the organizers here for this conference. I would like to introduce the co-organizers. Bill Lang sitting there. You want to stand up? Paul Kalem talking over there, both from Philadelphia Fed, and Professor Ken Kopecki from Journal of Economics and Business. Thank you very much for working with me in organizing these sessions. And looking around the room, I see a lot of experts and thought leaders in this area from various organizations, from academia, from financial services, regulatory agencies. I see a lot of modeling experts and policy makers in this room. So it's very wonderful to have you all here in the same room, and we look forward to stimulating discussions over the next day and a half. Now, I am honored to introduce our first speaker, Blake Prichard. Blake has been our acting president and CEO at the Federal Reserve Bank of Philadelphia since March of this year. Blake has been with the Federal Reserve System for over 4 decades. In 1992, he joined Philadelphia Fed after 20 years of service at the Boston Fed. In year 2011, after having led several key divisions here at the Philadelphia Fed, Blake was promoted to First Vice President and Chief Operating Officer. Blake is a known, accomplished leader who combines his deep knowledge of the Federal Reserve System with his superb operational expertise and people leadership skills. He has also been actively involved in the community. I remember soon after I joined Philadelphia Fed in 2008, Blake and I were among several Federal Reserve volunteers at the United Way Service Day at Manna, and we were working in the kitchen, packing food and cutting vegetables. And we noticed that Blake used the other side of the knife, the blunt side, to scrape the vegetables off the cutting board, and explaining that this would keep the cutting edge sharp. While Blake hones all organizations he leads to excellence. We are so fortunate to have Blake here with us today. So please join me in welcoming our president, Blake Prichard.
Well, that's a very kind introduction. And it is true that I'm not the real president. I'm the acting president. So if I appear to be just acting, that's why. So I'm going to compare my remarks here to the Gettysburg Address, mostly in terms of brevity, not in terms of profundity. So I'm just going to dial down your expectations. Sincerely, I am very, very honored to be here today to welcome you to Philadelphia and to the Federal Reserve Bank of Philadelphia. This is a very important conference. When Julapa asked me to offer some welcoming comments, I couldn't say no. The agenda is just, I think it's compelling. It's not just a great agenda, it's a compelling agenda. So I had no doubt that we were going to fill the room with the best of the best people who are going to want to engage on these topics. So I'm very excited about this conference. And again, I applaud the planners for all the work. And I applaud you for recognizing it for what it is. Consumers define our economy. So whether they're driving the growth of our economy, the GDP, whether they're characterizing the unserved needs of key segments of our population, or whether they are a key indicator of a new business cycle, consumers are essential. Access to credit, fair credit practices, and even general availability of credit are all issues that need constant study and attention, and in many ways, a careful hand of regulation to ensure the desired outcomes that we all want for our nation and for our nation's population. Credit is the grease of the economy. It is actually the lubricant that makes a lot of things happen. And its absence or its misuse is often a broken record of disruptions to markets, disruptions to businesses, and disruptions to actual lives. So this is truly important. All the work, all the dimensions, all the different topics that you have arrayed for today and for tomorrow, I think are very exciting in probing some key issues in this space. So your program today and tomorrow presents a variety of topics. I think it's got something for everyone. And hopefully it has a satisfying experience for all. Some of the topics you'll connect with more than others, but I hope as a compendium of topics, it really works for everybody here. So again, I thank the planners, I thank you as participants, and I particularly want to give a shout out to the authors and the presenters for all the material that you're going to have today and tomorrow. It's very, very exciting. I wish I could stay with you for every minute of it because it is so good. However, I got 2 jobs I got to do, and I got to get back to both of them right now. So with that, I'm going to turn it back to Jalapa to introduce, I think, Bill Lang.
Now, I am delighted to introduce our next speaker for the opening remarks, Bill Lang. Bill is Executive Vice President here at Philadelphia Fed. He oversees the discount window and bank supervision. Bill joined Philadelphia Fed in 2002 to start a new group on retail risk analysis. He soon developed the group to become the expert resource for the entire Federal Reserve System on consumer credit, including the Basel framework, Basel qualification reviews, and CCAR stress test modeling. Bill is a well-known economist who has contributed significantly in the areas of bank supervision, risk management, and credit risk modeling. He has remained active in his research and repeatedly published his influential research in top academic finance and economics journals. Now, significantly, Bill blends his serious academic credentials with his exceptional people leadership skills. He has provided crucial direction in bank supervision at both the district and the system levels during the financial crisis and the recovery period. Prior to joining Philadelphia Fed, Bill was with the OCC running the Special Studies Group, and he received his PhD in economics from Yale University. Bill is also a member of the Wharton Financial Institutions Center. I am privileged to have had the opportunity to work closely with Bill here in Philadelphia. So please join me in giving a very warm welcome to Bill Lang.
Thank you. Well, thank you, Jalapa, for that overly kind introduction, but much appreciated. Welcome to all of you here. This is, just looking around the room, a tremendous array of talent and skill, and I think the next 2 days are going to be pretty impressive in terms of both the presentations and the discussions I expect to have. In my discussion this morning, I thought I would take some time to discuss issues that really are more along the lines of a risk practitioner, a risk management practitioner than perhaps an academic, but I think has some important academic or research implications as well. I wanted to touch on the topic of quantitative risk analytics and their role in mitigating risks in the financial system. To elaborate on this, I'm going to discuss some of the lessons learned from the failures to adequately identify risk in consumer credit markets prior to the crisis. Now, more effective use of quantitative analysis to support regulation and supervision has been a central objective of this Reserve Bank for over a decade and has become a central focus of Federal Reserve System supervision, particularly in the aftermath of the financial crisis. This reflects post-crisis reforms of supervision that are emphasizing a more data-driven and a more multidisciplinary approach to addressing risk in the financial system. So my remarks, I'm hoping to convince you of two propositions, which maybe I'll convince you of, maybe I won't, but we'll see. The first is that when we think about risks in the financial system, really in any place, but particularly in the financial system, they're very dynamic and importantly evolve endogenously. In particular, they evolve endogenously to avoid detection by whatever the existing risk measurement system existing. Now, regulatory rulemaking, almost by definition, is a slow and cumbersome process, just the nature of the beast, and probably is slow and cumbersome for some good reasons in most instances. So while strong regulatory rules are essential, they also need to be combined with effective and nimble supervisory processes, risk detection processes at the supervisory level. So that's proposition number one. Proposition number two is to be successful over the long term, quantitative risk analytics must be effective at determining the most important unknowns that require direct investigation or additional data. That is, effective risk analytics should not only produce very good risk estimates, but need to be effectively integrated into a more comprehensive supervisory decision process. I'm talking about this from a regulatory point of view. If I were talking about it from a firm point of view, I'd be talking about their internal risk management processes. So to illustrate why I think these propositions are correct, I'll focus on a couple of key questions related to the mortgage crisis. Why did industry executives and regulators fail to recognize the growing risk posed by mortgage market trends prior to the crisis? And then, how does the answer to that question inform us about optimal methods for identifying and managing risk? So I'm obviously going to take a narrow slice of that question. It's way too big to talk about in 20 minutes or so. But I will take a few slices of that to try to illustrate the points I made before. So one common answer to this first question of why did people miss things is very simple. Market participants were optimistic about consumer credit markets in general and mortgage markets in particular, mortgage and housing markets. So financial firms and households took long positions in the mortgage or housing market. When that housing market turned, voila, they took lots of losses and the ship went down. There is no doubt, and a great deal of evidence, a lot of it produced by people in this room, that optimism and expectations were very high. There was a robust and rosy view of where the housing market is, and I'm talking, of course, generally. There were always people on the other side of that, but the general expectations of market participants were very positive. However, as I will try to discuss, this explanation, while it contains a lot of truth, is a very partial truth. The focus of my talk is not going to be, as I've seen in many other comments about this, about why that optimism was wrong. I think that's a rather uninteresting question. After the fact, everyone becomes a lot smarter, and pointing to ex-ante misjudgments is shooting fish in a barrel. Rather, I want to focus how commonly held beliefs are often used to short-circuit deeper analysis and promote groupthink. In addition, I'll talk about how risk analytics can provide an effective challenge to that kind of groupthink. So there are a number of versions, and you could probably list about 20 of them. I'm going to just list a couple, given the time. Two of the most significant examples about optimism from this period are, one, the view that consumer credit is not risky per se. Probably most of the people in this room wouldn't have agreed with that statement even prior to 2007. But I can tell you lots of people, both in the industry and regulatory community, held that view. And the view was that because it was made up of lots of small loans, a large number of small loans, no reason to worry about the uncertainty issues in consumer credit. The second one that I'll talk about is the belief that national house prices couldn't decline, or the even more optimistic view that house prices would continue to rise as they had risen before. So let me talk about those one at a time and what implications I draw. So when I began working on consumer credit issues, particularly here at the Fed, as part of my supervisory responsibilities, I would routinely, and I do mean routinely, I would say almost always, hear from senior executives and fellow regulators that a large nationwide consumer credit portfolio could not be subject to substantial credit risk. And I differentiate credit risk from other kinds of risk, operational, et cetera. People would have agreed that mistakes could be made and operational mistakes could be made. But the idea of credit risk as such was not something to be worried about. And the intuition or the rationale given was quite simple and at first glance perhaps intuitive. Consumer portfolios consist of a large number of small loans. While the outcome of any single loan might be uncertain, if you take the average rate of default, and the average default rate could be high, the uncertainty about that average default rate wouldn't be very high because there were so many and they were so small, and you could take an actuarial kind of view of what the default rate would be. I know some of you in this room are going to say that's a fairly foolish notion, and it was, but I can tell you it was a widely prevalent notion. In a 2004 paper with Tony Santamero, then president of this bank, we were trying to combat this view. I'll quote from that. Many practitioners in the retail lending area mistakenly believe that the law of large numbers implies that the distribution of retail outcomes will show little variability around the first moments of the distribution. Theoretically, the law of large numbers implies that the idiosyncratic components of individual loan risk will be relatively unimportant. But it does not imply that movements away from the mean generated by systematic risk factors will be small. And again, probably most of you in this room would have thought about that in advance, but it was a widespread contrarian view to that people held. Now, the statement that consumer credit risk was small as a theoretical matter is simply incorrect. It's just, as a theoretical matter, is simply incorrect, if an incorrect understanding of statistics. On the other hand, the risk for any particular portfolio could be small as an empirical matter. The important point is that this proposition was used as an explanation for failure to spend resources on estimating tail risk for consumer portfolios. And I'm not talking about this as a theoretical matter, I'm talking about as a factual matter when you went to many of these institutions. In fact, the main issue of the paper that I wrote with Tony that I just quoted was to explain the following puzzle. Why were bank quantitative models of capital and tail risk developed largely for commercial credits? Well, almost no work had been done on similar work for consumer portfolios in the banking industry. This was particularly puzzling since consumer credit is driven almost exclusively by statistical analysis. And it was very hard to find that analysis in any of the large banking firms that I had the opportunity to look at in terms of what they were doing. I'll put as an aside, we were being a little politically correct in not pointing out that in the regulatory community, it was routine for reports of exam to say X portfolio is safe because it is a consumer portfolio. It was a routine matter to see that in exam reports without much further analysis. My point here is not that optimism about tail risk in consumer portfolios turned out to be wrong. In any process with uncertainty, some ex post judgments will turn out to be better than others. Rather, my central point is that accepted wisdom or groupthink about consumer credit was often used as a rationale for less rigorous analysis and lack of attention to, and in cases where there was stress analysis conducted, lack of attention to that kind of analysis. Let me turn now quickly to the optimism around house prices. There's a great deal of evidence that house price expectations were generally optimistic, really up until the mortgage crisis itself. Just as an aside, when I refer to pre-crisis here, I'm referring to the period prior to the summer of 2007. A lot of people discuss the crisis as happening post-Lehman, and depending on exactly what aspects of the crisis you're interested in, there are some reasons to focus on post-Lehman. But the period beginning in 2007, so the Lehman bankruptcy is when the levees break. But you can think of the period of in early 2007 is when the hurricanes were reaching land, the waters were rising at a very alarming rate, and the stability of the system was coming into question. And all of that was happening with a national house price decline of roughly 5 to 7%. My colleagues in the Fed, Chris Girardi, Andreas Leonard, Shane Sherlin, and Paul Willen, published what I think is a very convincing paper showing that analyst reports indicated a lot of optimism about future house prices, basically right up until the crash. What I found even more interesting, the paper, again, I think is fairly convincing, showing that the models produced by analysts indicated very high mortgage default rates in the event that housing prices declined. So when stress analysis was conducted of those models, they may not have been exactly right, but in rough orders of magnitude, they weren't terribly off. And some of them even had stress analyses conducted with what roughly happened in 2007. And even within the Federal Reserve, there was analysis indicating that default would rise severely in the event of house price declines. There was a number of analyses that were very similar. Just as an example, in 2006, there was an internal paper that was written here that said a plausible drop in residential real estate prices would significantly increase mortgage losses and weaken industry earnings. My main point, and I think made better by the paper I cited, is the idea that people had no idea that a house price decline would lead to large mortgage defaults is not an accurate truth. So it's clear that industry participants and other experts were optimistic about housing prices and therefore took bets based on that level of optimism. The bet had paid off for a long time, but then it didn't. Simple enough. It's not particularly useful to spend a lot of time on why people were stupid, incorrect, didn't take the right bets. Market participants have plenty of financial incentive to produce good forecasts. So there's no obvious externality that is subject to regulatory correction. there's no reason to believe that regulators or other policymakers are better than market participants in forecasting the direction of asset prices. However, the notion that market participants make large forecasting errors is not the entire story. Optimism or pessimism basically tells you what side of the bet you're going to take. It doesn't really tell you how big a bet you are willing to make. That depends on risk-reward preferences. And so the interesting question to me is not why some firms were long in mortgages and others were short, but rather why those firms were so long in mortgages that they came under severe distress when the housing market turned by what I would consider relatively modest amounts in 2007. It is even more puzzling if you buy into Girardi and his co-authors' paper that says they had a pretty good idea if house prices went down, tons of mortgages would default. Why were there only a few firms? And by the way, there were a few firms who attempted to protect themselves from that outcome. How is that possible? So there are a bunch of explanations. In a 2010 paper I wrote with Jalapa, we discuss in some detail our view of how this disconnect could occur. There are obviously a number of potential explanations. I won't go into all of them. The one that is quite popular is that senior executives and shareholders at these firms weren't concerned about risk because they had a too big to fail subsidy, they were protected, and therefore going gung-ho seemed like a good idea. Certainly one plausible explanation. I don't think it fits with the facts, and Jalapa and I spent some time going through that one and why we don't think that fits with the facts. We argue that the evidence supports the view that the most senior executives at most of those large firms did not in fact understand their true exposure to mortgage defaults. That is, they couldn't translate accurately what large mortgage defaults meant financially to their company. And the reason they couldn't was those exposures had been relabeled and disguised within the structured finance market. This observation or conclusion is supported by a 2009 senior supervisors group survey of major international financial firms. And so this is 2009. And they found that many firms were still unable to accurately aggregate their exposures to mortgage-related assets 2 years after the mortgage meltdown. So I'm going on the simple proposition that if they couldn't do it in 2009, they probably couldn't do it in 2007. The other point that I'll make shortly without going through all of the arguments we make in that paper is there is evidence that in a few cases where senior executives actually had a very accurate view, they took a different tact. They changed from being very long to either being neutral or modestly moving in one direction or another. And in other firms, in a few other firms who recognized their inability to size the exposure, they also, and focused on that question, they also pulled back as a result. The optimistic view of the housing market not only provided a reason to place one side of the bets, it was also used for a reason for not expending the kinds of resources you would need to do to accurately understand exposure. It was possible to do. It was not a matter that it was impossible to do. It just required resources and expenditures. Expenditures that were seen as not worth the effort, given how safe things were automatically to be. So what are the lessons I draw from that? And what do I think are relevant to questions of regulation and supervision in the future? The first lesson is the need for designing organizational mechanisms to combat that kind of groupthink and that provide effective challenges to conventional wisdom. There's a lot of literature on this kind of thing in organizational theory, decision theory, and psychology. There is very little, if any, academic, regulatory, industry analysis examining whether or not these methods are at all useful in the financial context, but worth doing. The second lesson I draw from the pre-crisis experience is that dynamic markets will generate risks that are structured to escape detection. In standard finance, risks are generated by exogenous stochastic processes. The role of risk analytics is to estimate that probability distribution of potential outcomes, and then decisions are made to maximize whatever the objectives of the firm or whoever is making, or the household. The finance view of risk actually contrasts with a much older view of risk that was dominant among bankers. And if you run into old-time bankers, you'll still hear it the same. And that view emphasized the endogenous generation of risk from operational errors or intentional fraud. That is, risk was about making mistakes, not about exogenous stochastic processes. Now, of course, neither extreme view is correct. Risk arises as a result of stochastic outcomes. A lender makes loans to a group of mortgage borrowers, and there will be some probability distribution over the number of those borrowers who will default because they lose jobs, they become seriously ill, or because the macroeconomy does poorly. But risk also does arise endogenously. The classic example is that of a rogue trader. And the appropriate response to that type of risk is usually enhanced internal controls or creating incentives that align employees with the objectives of the firm. But those mechanisms sometimes break down and are ineffective. So insofar as risks are generated endogenously, there is a natural process for new risks to arise that escape the existing methods of risk detection. It's easiest to think of that in a conscious context, that is, people are figuring out ways purposely for doing so, but it also happens in a much more unconscious and natural way. People do things that nobody is stopping them from doing. They're making money. They continue to do them. And if they escape the risk detection methodologies of the time, this turns out to be a good strategy for certain people within the firm. An analogy would be the process for combating cybersecurity threats. At any point in time, there's a set of technologies and a set of actions that pose threats. You build a system that detects those threats, and then the other side figures out new threats that evade that detection. Again, it's easier to think about these in a very conscious way, but it also happens in an evolutionary way. This doesn't mean that risk analysis is not critical or useful. First of all, many risks are driven by stochastic outcomes. A lot of risks are driven by stochastic outcomes, and being able to estimate that distribution is very, very important. In addition, the more robust a risk measurement system is, the more difficult and slower are the means of getting around them or finding holes in that detection system. But finally, and I believe most importantly, when done well, risk analytics does one other thing that is often missed. It also points to those areas that are important where we don't know enough, where we don't have enough information. The information could be data, additional data. The information could be you have to go look at exactly how that business is operating and understand how exactly it's working. So what does that mean for the changes that are now going on in supervision and regulation that have occurred since the financial crisis? Well, regulatory reform and changes in supervisory practice have greatly increased the importance of the statistical analysis being done. We are light years, and I do mean light years, ahead of where things were if we went back to 2007 in using data and data analytics in the supervisory process. This is a tremendous innovation. I am proud to say that the Philadelphia Federal Reserve has played, I think, a very, very significant role in pushing those innovations forward. However, to obtain the most out of these new tools, including the stress testing that we're very much involved in, it is critical that they be used effectively in coordination with our examination authority. These tools should not only be good for supplying risk measurements, they should be used effectively to determine those areas of uncertainty where we send in additional resources or request and get additional data. At the end of the day, there is no set of regulations and no supervisory tools that will be foolproof if we also want to have a vibrant financial system, which, by the way, means we have to have a financial architecture that's resilient to all of these methods failing at points. But that's another subject for, at least for me, for another day. However, we can have regulations and tools that make the system more resilient. We've made a lot of steps in that direction, but in some of the areas I just talked about, I think we have particularly a long way to go. So I'm very much looking forward to the conversation over the next few days. I don't know if we have any, we probably have time if anybody either wishes to comment, yell at me, or questions. Yeah.
Doug McManus, Freddie Mac. I had a question from a supervisory view. How do you deal with cases where there's a tension between actuarial or statistical models and market pricing, particularly of things like PLS tranches? And those pricing results are giving you a very different view of what house prices, the future house price process would likely be. There's frequently a predominant view that the market pricing tends to be right. The statistical models are statistical models and may have flaws. How do you deal with that tension?
So that, I think, is a good example of what I hope I'm talking about. There's no ex-ante way of saying, I know the market prices are better, or I know the statistical model is better. These are two sources of information. Depending on what our belief about our statistical model, we might have close to zero confidence relative to the market price or not, or we might have more confidence in it. The question that should then be asked is, how confident are we in these statistical analyses? We're getting different signals. Is that the kind of thing that requires more investigation? I will tell you, and by the way, that is a process that I think is working better now than it used to. We are looking a lot more at places where market signals are giving divergent messages from our other kinds of analysis. So I think that's actually been one of the things that is working better than it used to. It used to be, just speaking personally, something which I would bring up in the exam context of, I'm looking at the market, it's not, so it was very hard to convince people that that was something worth paying a lot of attention to.
You mentioned in passing operational risk in terms of documentation in the mortgage space. And I have some results that show that that was really a very big picture. As you say, people were not really pursuing what they needed to do to perfect the liens and keep the titles. And they were getting away with it, so they saw no reason to change their behavior. And I wonder whether or not you've seen that in, in supervision, and what's happening to prevent that in the future.
Yes. The short answer is yes. You may remember that I was at the Board of Governors during the robo-signing incident, and we saw a lot of it, a lot of the repurchase and legal risks that have come from all of that. So operational risk has been a big factor here, and not just sort of the simple credit story. Some of these very large losses have piled on because of that. And I don't know, actually, maybe somebody else in the room, how much the legal risks have tallied relative to the credit risk, but they're pretty large numbers.
Regulatory fees as well, so you wonder whether or not there was a net gain in the too big to fail, actually.
Okay, I think we should, do we need to move on to our first panel? Thank you very much.